We're joined by David Dietze, Managing Principal and Senior Portfolio Strategist at Peapack Private Wealth. David, it's great to talk to you. You've seen one or two market cycles in your time. What's your feeling when you talk to colleagues? Are we at that magical point of capitulation where people say, I never want to own another stock?
Well, Andy, good to be with you this morning. You know, there's never any bell right at the bottom. But certainly we have a confluence of factors that suggests, as you point out, referencing that 2008 situation, that this is the time for investors, particularly long-term investors, to step up to the plate. Now, things that we like here is the valuations are much better. I mean, the fact of the matter is, depending on the index you're looking at, you're down anywhere from 15 to 35% this year. I mean, the numbers don't lie. What I also like about this is that the sentiment is getting so negative. You know, it started with Wall Street, of course, is now increasingly rattling the drums of a recession coming up ahead. They may be right, but the historical record of economists, much less money managers, picking the economy and what's going to happen is very, very poor. Now, of course, you're seeing that with corporate America. Although, you know, generally we've had some strong results of companies that have reported already. The problem is their outlooks are starting to get very negative. Why? Because they, too, are forecasting bad times ahead. You know, just recently, Goldman Sachs, for example, talked about cutting back on hiring. Yesterday, of course, the mini nasty news du jour was Apple, the largest stock on the planet. They're now talking about reducing headcount and scaling back on plans. Is their forecast any better than the rest of us? But the fact of the matter is it's bleeding in, and that's setting up I think the conditions that for longer term investors, they can take advantage of this pessimism to their advantage.
It's interesting. I'm just looking at the famous headline, 1979, August. Newsweek had that cover. The death of equities, how inflation is destroying the stock market. Now, I know there were another couple of years of rough sailing, but 1982 was one of history's great bottoms in the stock market.
Yeah, absolutely. But I mean, there's reason to be optimistic just before the end of the year. So historically, the back half of the presidential term here in the States has been a better one than the first half, particularly in Q4, because of course at that point, for the most part, we'll be past those midterm elections, which of course are putting people on tenterhooks. You also look at the statistics. Well, you know, the first half that we saw was one of the worst on record for decades, going back to 1970, I believe, on the S&P 500, 1962 for the Dow, and that historically has laid the ground for a rebound going forward. But I think the key things, the key fundamental right now is inflation. And I believe that we are seeing signs of that starting to roll over. The most important number in this economy here is the price of gas at the pump. And the latest report is, I think now 50 days in a row, that price of gas has started to inch down. We're back around $4.50 U.S. per gallon. So we're well off that 5. And that's going to improve sentiment in terms of the forecast for consumers in terms of inflation going forward. And I think ultimately that's going to impact the Federal Reserve's thinking as to what they want to do with rate hikes. You think commodities broadly, and of course it's very hard to generalize, but you think commodities have peaked? Yes, I do. I do. You do need to look at it one by one, but certainly that is an advantage in terms of the bleeding edge of where inflation may be going here. Commodities tend to forecast very well. I think the best one is copper, sometimes called Dr. Copper because of its uncanny ability to predict future conditions. It's at about a 20-month low here. So the pessimism is built in, and the next move may be up. Why would that be? Because I think ultimately the Federal Reserve increasingly is going to realize that inflation is not the only headache they need to deal with. They need to respond to these concerns of these blue chip companies as to economic conditions ahead. They're going to see that gas prices move down. And I think they will indicate that they're going to be a little less hawkish in terms of their sentiment and actions. And that could lay the groundwork for a better stock market here in the second half. Although, David, you do note that we've seen a lack of
of investment in important commodities, new sources of supply. So you're not an out-and-out bear on commodity producers.
Right. And of course, the most important thing here in investing is diversification.
Yep.
We could be wrong. Inflation actually could worsen. And so we do counsel our clients to maintain positions in energy, maintain positions in commodities, because if in fact inflation does get out of hand, for example, there could be more geopolitical issues. China could rebound very rapidly. You will do well by having one foot in that commodity camp. There, of course, we suggest people use the stocks of commodity producers who try and often hedge their prices received and are able to make a profit even in a flat market on commodities. One
idea you have for our viewers, I'm sorry we can't get to them all, is Intel. Why would you favor Intel right now?
I mean, we started the year, we were told there's a chip shortage. And so what happened? And this is why you always have to be skeptical of the latest headline du jour. The chip stocks have been down about 38 to 40% as a group here. And so we think they will come back. We know that the usage of chips will double by 2030. It's going to be most important in automobiles as we move to self-driving autonomous. And then, of course, smartphones. Intel, you've got a close to 4% yield. You're under 10 times earnings. They are the standout American producer, and we know that we want to have more production here onshore. Of course, it's in front of the Senate now as to whether to provide a $52 billion package to encourage development of chips here. We think Intel is well positioned to take advantage of the inevitable secular drive towards more use of semiconductors.